Right now, as we speak, Navitas Semiconductor Corporation is trading at exactly 7.78 USD. On the surface, the ticker looks flat, unchanged at 0.00% for the day. But do not let that stagnation fool you for a single second. That lack of movement on the screen is not stability. It is the deceptive calm of a coiled spring under immense tension, sitting right at the center of a brutal tug-of-war between aggressive institutional short sellers and a retail base that is betting everything on a massive technological pivot. Most people looking at this chart today see a semiconductor stock that has had a rough year, maybe something to watch for a bounce later. The reality is far more volatile. What you are actually looking at is a company that is effectively attempting to transplant its own heart while running a marathon. We are watching a live-action stress test of the entire Navitas 2.0 thesis, where the company is actively abandoning its legacy revenue streams to chase the high-stakes power demands of AI data centers. The market expects this transition to be slow, painful, and filled with cash burn, which is exactly why the short interest is stacking up. But if the reality of their silicon carbide and gallium nitride integration accelerates even slightly faster than the bears anticipate, that 7.78 price tag is going to look like a historical artifact very quickly. Let's push past the headline price and look at the mechanics of what is happening in the order books right now. You might see 7.78, but the volume profiles tell a story of hesitation. Buyers are stepping in tentatively at these levels, likely waiting for confirmation that the bottom is truly in, while sellers are not aggressively pushing it lower today, perhaps exhausted or wary of a reversal. This creates a standoff. The expectation from the broader Wall Street consensus is that Navitas is dead money until at least late 2026, a company caught in the valley of death between their old consumer mobile business and their new industrial future. But here's the contrarian angle that demands your attention. The semiconductor cycle is rarely linear. When a company shifts focus to AI power delivery, specifically the high-voltage systems needed for the next generation of NVIDIA and AMD racks, the valuation multiples can expand long before the revenue actually hits the bank account. The market is pricing Navitas like a struggling phone charger chip maker, but the company is operating like an emerging AI infrastructure play. If that latter reality takes hold, the mismatch between the current price and future potential is staggering. The most immediate and pressing factor you need to be aware of is the short-selling pressure. This is not just normal market hedging. This is a crowded trade. Recent data indicates that nearly 30% of Navitas's floating shares are currently sold short. That is a massive, dangerous number. To put that in perspective, anything over 10% is considered high. Approaching 30% places NVTS in the upper echelon of potential squeeze candidates. Short sellers are effectively betting that the company will run out of cash or fail its pivot before it can become profitable. They are paying borrow fees, which have fluctuated but remain a cost they are willing to bear just to bet against this stock. However, this creates a precarious situation for them. With days-to-cover ratios hovering between 1 and 2.5 depending on volume, any sudden catalyst, a press release about a new data center win, a favorable analyst upgrade, or even a broader sector rally could force these shorts to cover simultaneously. When you have 45 million shares that need to be bought back in a hurry, and the daily volume is only around 16 to 20 million, the math simply does not work in favor of the bears. The exit door is too small for everyone to fit through at once. This structural setup means that the downside might be capped by the sheer necessity of shorts needing to eventually close their positions, while the upside has the explosive fuel of a squeeze. Investors need to be incredibly vigilant about the failed-to-deliver data we have seen spiking periodically over the last few months. When you see spikes and fails to deliver, it often suggests that there is naked shorting or at least significant liquidity strain in the lending market for the stock. It signals that the bearish bets are getting stretched. If you are holding shares or considering an entry, you are not just betting on the company's fundamentals, you are stepping into a liquidity battle. You need to watch the borrow fee rates next week closely. If you see the cost to borrow shares spike suddenly from its current levels, that is often a precursor to a squeeze, as it forces the weaker hands on the short side to fold. Conversely, if the short interest continues to rise while the price drops, it means the bears are doubling down and you might see a test of lower support levels around the 750 mark. This is not a stock for the faint of heart. It is a battleground. Now, we have to address the fundamental pivot that is driving all this chaos. Management calls it Navitas 2.0, and while that sounds like corporate branding, it represents a complete overhaul of their business model. Historically, Navitas made its money selling GaN chips for fast chargers, the kind you use for your phone or laptop. That's a great business, but it's a commodity business. Margins are tight, competition from China is fierce, and the growth ceiling is low. The new strategy is to take that same GaN technology, combine it with silicon carbide, and aim it at the monsters of energy consumption, electric vehicles, and AI data centers. An AI server rack consumes staggering amounts of power, and traditional silicon chips are becoming the bottleneck. They get too hot, and they're too big. Navitas is pitching their tech as the solution to shrink those power supplies and make them more efficient. The tension here is that while the story is perfect, the execution is messy. Revenue from the legacy business is falling off a cliff, down over 50% year over year in the recent Q3 report, while the revenue from the new business has not fully ramped up yet. This creates a terrifying air pocket in their financials, where income drops before it grows again. This financial air pocket was brutally apparent in their latest earnings report. Revenue came in at roughly $10.1 million, which was a sharp decline and missed some analyst expectations. The net loss widened. When you look at the income statement, it's ugly right now. They're burning cash to fund R&D for these new high-power chips, and they're doing it while their main source of income dries up. This is the valley of death I mentioned earlier. But you have to look at the balance sheet to see if they can survive the trick. They have around $150 million in cash and cash equivalents. Where the quarterly cash burn that has been managed but is still significant, they have a runway, but it's not infinite. This brings up the risk of dilution. We have seen them raise capital before, and the fear of another stock offering is likely keeping a lid on the share price. Every time the stock rallies, investors worry the company will issue more shares to pad their war chest, diluting existing holders. That is a valid fear and one you must factor into your risk management. However, let's zoom out and look at the sector momentum. The semiconductor industry is currently bifurcated. You have the AI winners like Nvidia and Broadcom making all-time highs, and then you have the analog and power chip makers like Texas Instruments and ON Semiconductor facing cyclical headwinds. Navitas sits in a unique spot because it's a power chip maker trying to attach itself to the AI train. If they can prove to the market that their chips are physically designed into the next generation of AI power supply units, the stock will decouple from the cyclical downturn and trade on AI multiples. There have been rumors and analyst chatter about design wins with major Tier 1 suppliers who feed into the data center giants. If any of those rumors are confirmed with a hard purchase order, that 7.78 price tag you see today will be a distant memory. The market is pricing in failure. It's assuming the transition will take too long, or that competitors like Infineon or Wolfspeed will eat their lunch. A successful contrarian bet here relies on Navitas being faster and more agile than those legacy giants. Let's talk about the chart technicals, because they're painting a fascinating picture of compression. The stock has been battered, down significantly from its 52-week highs of over $17. It found a brutal bottom near 1.52 earlier in the year, a complete capitulation level, and has since staged a recovery to this $7 to $8 range. What we're seeing now at 7.78 is a consolidation phase. The stock is trying to build a base. Technical traders would look at the 50-day moving average. If the price can hold above that line, it signals a change in trend from bearish to neutral. The volume on the down days has been drying up, which is a classic sign that selling pressure is exhausting. The sellers have sold. Who is left? If the buyers step in with any conviction, the lack of overhead supply could allow for a rapid move back toward the $10 or $12 level. However, if 750 fails as support, the next leg down could retest those capitulation lows.
It's a binary setup, which matches the binary nature of their business pivot. I want to take a moment to address the retail sentiment, because in stocks like this, the crowd psychology is a fundamental driver of price. If you go to the forums on Reddit or check the streams on X, the conversation is deeply divided. You have a camp of investors who are furious, people who bought in at $15 or $20 believing the next Nvidia hype and are now sitting on heavy losses. Their sentiment is full of despair and anger at management for the dilution and the revenue drop. Then you have the new entrants, the opportunists, who see the $1.6 billion market cap and think if this company captures even 1% of the data center market, it's a 10-bagger. This clash of despair and greed creates the volatility we see. When a stock is hated this much by its own long-term holders, it often marks